The Fed has been trying to talk this market down.
I think the Fed has to sleep with one eye open.
The markets are fighting the Fed, as they've frankly been doing all year.
The Fed is going to have to continue to raise rates or stay higher for longer.
To pause at a time when you're significantly raising your forecast both of inflation and of the level of rates that we're going to have to get to deal with the problem, Powell has a tough job.
Forget about the chance of cutting this year.
It's a mistake to ask central banks to solve inflation all by themselves.
Months ago, it seemed like we had an extreme banking collapse on our hands. Thankfully, though, the Fed stepped in and saved the day and stopped the US economy from collapsing. But now it's looking like they just prolonged the problem and kicked the can down the road like they always do, and the banking collapse has reared its ugly head once again. Now, as we've mentioned multiple times on this channel and in previous videos, the Fed is going to continue to raise interest rates and hike them until the economy breaks or inflation breaks, whichever one comes first. And just a reminder, May 30th, I posted this picture on my Twitter, and this was what the banking collapse was looking like just 3 to 4 months ago, where you had some of the largest banking collapses right here, like First Republic, Silicon Valley, and Signature Bank. And you really think it's just going to stop there, especially when you look back at 2008 and see how it escalated? Now, unfortunately, when we take a look at some of the data points and surveys that have been conducted, it looks like the US yield curve may remain inverted for an unprecedented duration of time. And we're going to look at some of the charts and the data points and see how bad it actually is. Unfortunately, a lot of people think that the yield curve would turn positive in the greater parts of 2024, meaning basically the rest of 2023, what a lot of people think is that it's just going to continue to get worse and we're going to see more of an economic slowdown. And you remember how just even a couple weeks ago, a lot of people were still pricing in that we could get a couple rate cuts in 2023. Well, all of that has been basically deleted from the markets. And now people are pricing in that we're not going to get any rate cuts in 23 at all. And some people even believe we might get up to 3 or even possibly 4 rate hikes in 2023, which means that the Fed is just going to continuously get more hawkish and the economy is going to slow down even more. And in turn, the markets should also have an effect. And the last point to basically put this point home is that a lot of professional investors, when they asked over 278 respondents, they believe that government bonds will be the best investment for 2023, basically meaning that stocks, commodities, and basically all risk assets are going to do very bad in the later parts or the second part of 2023, meaning more economic slowdown is going to be happening. Now, of course, when we talk about the yield curve inversion, we're talking about the 10-year over the 2-year, and every single time it has inverted, we've had a recession follow it when it turns positive. And of course, what everyone always says, it's different this time. And the one thing that is different about this time is that it's never been this bad since the 1980s when we had massive inflation problems and a double recession within 1 decade. So yeah, this time is different from all the other ones because it's looking much worse. And when we're talking about the banking collapse, just a few months ago, it looked like we were about to have the U.S. economy basically crumble because of all of that. But thankfully, obviously, the Fed came in with the Bank Term Funding Program and basically shelled out like $300 billion to these banks and basically just put a Band-Aid over a large wound. But eventually, kicking the can down the road can only get you so far. And now what we're seeing is one of the deepest contractions ever seen in bank deposits for all commercial banks, which we can see right here. Now, there are 2 main things that you need to know about a low bank deposit. One is a liquidity shortage. Low bank deposits suggest that banks have less available liquidity. The less liquidity there is, the less money they can lend out to businesses, consumers, and also the markets, which means the markets and everything else is going to slow down. It also has a massive impact on interest rates. With lower bank deposits, banks may have less excess reserves to lend to each other in the interbank market, which is really bad. This reduced supply of available funds could potentially drive up short-term interest rates, making borrowing more expensive for banks, businesses, consumers, and also slowing down the economy. Now, you're going to start seeing these types of headlines pop up more and more and more, where a massive German bank may need recapitalization to cover bond buying losses. Basically, they're going to go out of business unless someone provides them with liquidity or money, or basically merges with them or buys them over, which is the same exact problem we were just having 3 to 4 months ago. Now, if we reel it back in and look back in the United States, you could see massive banks like Goldman Sachs is cutting over 100 managing directors globally as a part to basically deal with this economic slowdown and the slow of business. Now, while 125 people out of like thousands and thousands of employees may not seem like a lot, when you take a look at why this is happening, deal values have fallen more than 40% this year to $1.2 trillion for Goldman Sachs when they took a look at their data. Now, this is insane because their deal value has almost been cut in half. And when you look at other major banks like JP Morgan and Chase Co., they're also terminating 40 investment bankers as part of their effort to cope with the global slowdown. So this is kind of the first phase of it all, right? Unemployment is the last lagging factor in terms of US recession. And as we start to see more of these start to come out, first we had it in the tech sector where we had Meta and Amazon and Tesla, and they had their mass layoffs. But now when we see it in the banking sector, when they start laying a lot of people off, that's kind of like the last phase of it all. And that's when we really start to see the US economy start to tumble slowly and then once, all at once. Now, on top of this, one of Wall Street's most bearish strategists said U.S. equities are facing a wall of worry, which could fuel a sharp sell-off in the near future, basically for the second half of 2023. Now, the big thing with this is that when you look at the forward earnings per share for the stock market, they're still extremely elevated, even though we have a ton of uncertainty in the markets and in the overall economy. And the moment that this starts to slow down, as you could see during here in the pandemic, that also starts to sell off in the markets as well. And a big thing too is liquidity. We've already seen that US bank deposits are at extreme lows. The moment that our forward earnings per share start to fall, that's when we see these very large sell-offs in the markets start to happen as well. And as of right now, they're still pretty elevated as of making this video. And the strategist goes on to say that in addition to profit risks, he also reiterated that the headwinds from deteriorating liquidity due to record levels of treasury issuance and fading fiscal support are basically some of the driving factors as to why these earnings per share could fall. Basically meaning that we could see that sell-off happening here very soon once we start to get those interest rate hikes in July and August and September. And if you're on the side of cryptocurrency or Bitcoin specifically, you're also seeing the great accumulation rates of Bitcoin. And when you have to ask yourself, why are these mega asset managers getting into Bitcoin when there's still regulatory uncertainty? Could it be because they want to control the price or they want to make a massive profit? Or could it be because they're trying to protect themselves and position themselves in an economic slowdown, and they're trying to find the best investment possible for when the US economy does crash and these banks start collapsing? As you could see, Cameron Winklevoss goes on to say that the great accumulation rates of Bitcoin has begun. You're seeing a flurry of ETFs starting to go from Fidelity to Citadel to Charles Schwab to BlackRock. And he says the window of front-run institutional demand for Bitcoin is closing, meaning we are about to see one of the largest FOMO events in the next bull market happen for Bitcoin and most of all cryptocurrencies. And I think Dylan Leclerc puts it beautifully in this picture where you can see the percentage of supply last active in over a year is at some of its all-time highs, meaning that Bitcoin has not moved in over a year in these wallets, and that means the supply is illiquid, meaning it's not going to move until the prices skyrocket to points where people are finally comfortable selling to these institutional buyers. But because they're institutional buyers and because there's massive money flowing in, the price is going to have to shoot up just high enough for these people to be comfortable with selling their Bitcoin away to these mega companies, meaning that Bitcoin is about to see a parabolic bull market coming. And if institutional money want to set themselves apart and position themselves in the cryptocurrency market, they're going to have to pay quite a hefty price. But that's everything I have for this video. Obviously, with everything happening, it's very hard to tell when and how everything is going to play out. But the deeper we look into, kind of peek behind the curtain, the easier it is to see that there is still banking stress happening in the US economy. And as these interest rates start to rise, we're going to see a global effect take place. And while the US economy does seem resilient right now, obviously The way that these things work out is that nothing happens for a long time, and then everything all at once just continues to bear down on the economy, and that's when we see a massive collapse. Nothing, 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 and then all at once. If you guys enjoyed this video, make sure to subscribe, continue to watch these videos for updates, and I can't wait to see you guys in the next one. Peace.